Let's turn to private credit now. Are these economic headwinds a boon for the asset class? Let's ask Patrick William from Rixon Capital, who joins me now. Patrick, good to see you. So, how is private credit faring in the face of all this volatility?
In the face of market volatility, it's actually done really well. This is when a private asset class shines. The ASX 200 was down 4.2% on one day earlier this month. Private credit, nothing. And the key reason for that is our assets, our lending is underpinned on fundamentals, assets, cash flows, revenues, and underlying business. Whereas as soon as you're listed, you've got to throw in market sentiment in the mix. So by removing market sentiment, we're focused on the core assets. Do you have good assets? Yes. Can you pay interest? Yes. Are you going well? Yes. What more do you want?
So do you think then, given all the uncertainty and the fact that we don't know what's coming from the White House hour to hour, let alone day to day, there's going to be more demand for private markets?
Absolutely. I mean, one of the key drivers for the popularity of private credit the last 5-6 years is there's been so much volatility in the equity markets that, if you're an investor looking for a bit of stability in your portfolio, but a meaningful return, it becomes a very natural home.
What are some of the risks, though, that you're seeing emerging, perhaps?
The key risks, I think, are within specific pockets of the market. So you've got a high cash rate, you've got inflation, high costs, and a weaker Aussie dollar now, which is making imports quite difficult, but quite challenging for importers. So if you take out construction and consumer discretionary, those are areas of risk, and I think a lot of lenders are quite cautious. You take those two out, fundamentally, it's a reasonably strong market for a lot of our, for our borrowers definitely, and definitely for other people in the space.
Now, we are expecting a rate cut next month, the 20th of May. Some economists saying there could be 3-4 more this year. HSBC was telling me they see the cash rate 3.35% by the end of the year. What does that mean in terms of demand for private credit?
Look, if I looked in the crystal ball, I'd say probably not too much of a negative effect. At a first principles level, the implication is, when the rates go down, markets go up and people swap to equities. But the fact is, equities and private credit are two different asset classes. So we'll always have a space in a well-diversified portfolio. So fundamentally, there'll always be room for you there, or room for us there. Second is the fact that because that demand and supply disconnect in private credit, the risk-adjusted returns are exceptional for what they are. So even if rates drop, the returns in private credit won't drop by the full amount. So let's say rates go from 4.1 to 0.1. Private credit returns won't drop by 4% because there is more demand than there is supply of capital. So returns will still remain attractive.
So what do you expect to be, the outcome by the end of the year in terms of, I guess, how stable or how strong some of these returns have been?
Look, call it 1% worth of rate cuts for the next 12 months. There's a view that we won't have rate cuts as deep as that, but let's say that's what it is. Returns in private credit at worst will fall by 1%, at best probably 0.75. And the fact is we're cutting rates in a challenging economy. So if I was a conservative investor, I'd like to be in an asset class with, again, capital stability, the fact that I'm in the debt rather than the equity, which is dusted first, and an income stream. The beauty of private credit relative to equity is the fact that what asset class have you got in the market that gives you that stability and a check in your bank account every month like clockwork.
So Patrick, more broadly, what are you seeing in terms of, I guess, demand and activity in the space?
There's a lot of demand in the SME space, and what we're observing is, so the banks have been moving away from SME lending, but what we've seen is some of the big funds getting bigger. So when we started our fund 2.5 years ago, the big funds would lend from $20 million. Today, their checks start from 25 to 30. So we're actually seeing increased demand and actually a decrease in supply in that mid to small end of SME lending. So that's where we expect to generate really attractive risk-adjusted returns for investors.